Actually, there haven't been major changes at a top-down level required in the portfolio in recent times, although there's been quite a shift in what's been driving markets from technology to energy, for example. We were well placed, haven't had to make any changes to the portfolio on that perspective, although clearly the underlying stock pickers have taken an opportunity to take advantage of volatility and purchase some stocks that they weren't able to get at an attractive price prior to that. At a top-down level, as I said, we don't have big positions, but the one that stands out probably is that we're overweight UK equities at the expense of US and Canada, and really a number of the stock pickers finding some good ideas in the UK. Well, like the majority of equity trusts this year, it is down in absolute terms. Markets have been off a fair amount. However, on a relative basis, so far this year, we've slightly outperformed the MSCI All Country World Index and significantly outperformed the peer group with the other trusts in the global equity sector. Yeah, actually, after 55 years of consecutive increases in dividends every year, the board took a decision last year to significantly increase the dividend by over 30%. And so we're now sitting at a dividend yield of 2.6%. I'd make 2 points on that. The first being that this looks pretty attractive relative to other trusts in the sector. And the second point is that there's a lot of confidence that that can continue with growth in dividends from here, given the amount of reserves that are in place at Alliance Trust. So actually earlier this year, the first quarter of 2022, we actually had River and Mercantile exit as one of the stock pickers in the portfolio. We took the opportunity to rebalance and use those assets to increase the weighting to a couple of the other stock pickers in the portfolio that really followed the same kind of approach, so that we didn't move away from this relatively style neutral position in the overall portfolio. That said, there have been a number of changes within the stock pickers' portfolios as they've found opportunities, and GQG is probably worth highlighting as the largest weighting we have today. They changed their portfolio from being quite significantly invested in large cap technology stocks in 2021, which they did well out of, into energy sector in 2022, and so far this year that rotation that they've made has been very beneficial to performance. So I think the particularly exciting thing about this portfolio is that although it's diversified by number of stocks, it genuinely looks very different from the benchmark. And when we look at the aggregate statistics, it looks cheaper than the benchmark. It looks attractive from a growth perspective, and also has a higher dividend yield as well. So when you take the portfolio as a whole, that looks very exciting. When you also dig into the information as to how much of the returns on the portfolio have come from fundamentals in terms of the growing profits and dividends of the underlying companies, they're doing well as business operations, versus multiple expansion or contraction. In other words, the whims of the market liking one area of the market versus another. Actually, we've seen that we've produced some really good returns from a fundamental perspective and haven't yet had that fully reflected in prices. And so we're confident that over the next few years, that's something that could lead to significant outperformance in the portfolio. So with the way Alliance Trust is structured, we don't take big thematic bets at the total portfolio level from a WTW perspective. However, clearly, each of the underlying stock pickers have some themes running through their portfolios. Now, like most equity trusts at the moment, there are two big questions as to how portfolios are going to do well in a different inflationary environment. We've obviously seen inflation pick up, and so that's one theme. And then the second one is how they're going to do if growth tails off, and we could have a recessionary environment, for example. On the first of those, a number of our stock pickers have been able to play this inflation theme by investing in companies that are having low capital intensity and should do well on that basis. So Intuit would be an example of that. Have got significant pricing power, and so things like TransDigm in the portfolio might be an example that plays that, or that are more transaction-based revenues that will take advantage of prices increasing. And so things like Visa and MasterCard would be examples there. But the other question is this piece of what if growth stalls from here? And so what we haven't been doing is just investing in the classic defensive sectors like utilities, for example, as we think a number of those areas look pretty expensive as others have been flooding into them, given what's going on in the economy. Instead, we're actually finding some good opportunities in the high quality cyclicals that have really been hit on performance grounds, or indeed a number of the secular growth stories out there that have been hit like all growth areas in the markets.